কেমন করে একটি কোম্পানি বছরের পর বছর লোকসান করেও টিকে থাকতে পারে? In English, how does a business survive for years while constantly losing money? Economists have a name for these unviable entities, zombie firms. This is a chart of the entire market of publicly listed companies in the United States. According to the Federal Reserve's baseline estimates, roughly 10% of them are zombies. Other risk assessments like Credit Risk Monitor estimate up to 40% of US companies are unviable. A typical zombie firm is older, burdened by heavy debt, displaying consistently negative sales growth. It is important to separate these legacy corporations from high-growth tech startups. Many young companies operate without immediate profitability, but they are typically underleveraged, holding very little debt on their balance sheets. A true zombie is drowning in debt. These heavily indebted companies represent a hidden fragility in the stock market.
They survive not from consumer demand, but through external financial life support. That life support system was built during the era of cheap money. As central banks held policy interest rates at near zero, failing companies continuously borrowed at practically no cost. When crises hit, untargeted government stimulus inadvertently extended the lifespans of older, pre-pandemic zombie firms already on the brink of collapse. Consider the trucking giant Yellow. The company had been struggling for over a decade, relying on continuous borrowing and private equity. In its final years, Yellow stayed afloat entirely through a $700 million bailout loan from the government. The depth of their financial failure is clear in the repayment numbers. Yellow paid nearly $55 million in interest on that loan. But before the business shuttered and laid off 30,000 workers, they had repaid exactly $230 of the actual principal. The combination of 0% interest and government intervention stalled the natural market cycle. The economy stopped rewarding the fittest businesses and instead began preserving the most indebted. These surviving entities act as economic parasites. Because they operate in the same sectors as healthy firms, they actively crowd out viable competition. Every dollar and every worker tied up in a failing business is a resource blocked from reaching innovative, expanding companies. Bank capital flows into stagnant entities instead of funding new ventures that could create actual value. Banks are often complicit in this cycle due to loss aversion. Rather than admitting a past investment was a mistake, weak banks continue to extend new loans, keeping the firm afloat to avoid recognizing massive losses on their balance sheets. Preserving these failing companies actively depresses national economic productivity, suppresses wages, and suffocates overall market growth. To understand the severity of this threat, we only need to look at Japan in the 1990s. Throughout that decade, undercapitalized banks operated under weak regulatory supervision. They had every incentive to keep their own zombie firms alive, operating on the expectation that the government would eventually step in and bail them out. After 1994, the share of unviable companies in Japan shot up, triggering a lost decade, a prolonged period of severe economic stagnation and halted growth. Japan serves as historical proof that protecting weak companies to prevent short-term bankruptcies practically guarantees long-term paralysis for an entire nation. The Federal Reserve is currently dismantling the conditions that allowed the zombie economy to thrive. By raising policy interest rates by over 5.25 percentage points to combat inflation, the central bank has effectively ended the reliance on cheap credit. For an over-leveraged company, the math is brutal. Corporations used to borrow at near 0% for operating costs, but are now facing rates upwards of 9 or 10%. Survival is becoming mathematically impossible. We are watching the consequences play out right now. Through September of 2023 alone, 516 major corporations filed for bankruptcy, a massive, sudden surge from recent historical levels. The Fed's primary mandate was to cool inflation, but their restrictive monetary policy has triggered the long-overdue collapse of the zombie economy. This sudden wave of corporate bankruptcies is exactly what the global economy needs to heal. Economists and top regulators, including former head of the FDIC, Sheila Bair, argue that allowing these failing firms to finally die is a strict requirement for restoring a healthy market. When a zombie firm shutters, its trapped resources, its market share, its labor force, and available capital are released back into the ecosystem. Those resources can finally be absorbed by stronger, innovative businesses that generate real value. In an over-leveraged market, corporate death is the essential first step of market healing. Cash now holds real value as an asset class, creating an environment where high borrowing costs restrict reckless corporate risk-taking. The standard for corporate survival has changed. Companies can no longer rely on endless cycles of debt refinancing. They must now prove true operational profitability to keep their doors open. The transition will be painful. Banks must recognize bad loans, and the last unviable firms will be flushed out of the system. Shostatakar jog evarin motoshesh. The era of easy money is definitively over, and only operationally sound businesses will remain standing. To avoid a global lost decade, the financial system must accept the short-term pain of letting the dead finally rest. Thank you for watching. Please subscribe to the channel, leave a like, and share your thoughts on the market correction in the comments below.